Morning, everyone. Thank you very much for joining me. This is the morning market review with myself, Russell Shaw, my senior market specialist at FXCM. Please take note of my email address, rshaw@fxcm.com, and today is Tuesday, it's the 5th of July, 2022. I'm just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. Hey, Sam. Morning to you. Nice to have you on the webinar. Thank you very much for joining. Thank you to everyone for dialing in, logging in. I'm going to bring up our market commentaries disclaimer. And just finally, our references, MarketScope, cnbc.com, tradingview.com. And we're going to tackle this 2-year yield in a moment. Let's just go through the CNBC. Let's just go through the CNBC article. Okay, so the headline reads as follows: European stocks head for higher open as global markets look for gains after rout. Okay, so European stocks are expected to open higher today as global markets look to cement gains after a bruising week for stocks last week. The positive open for European markets build on solid momentum as the region's indexes closed higher on Monday, albeit wrapping up a quieter day for global markets given the 4th of July holiday in the US. Overnight, US stock futures rose early on Tuesday morning, with markets looking ahead to when the US Federal Reserve releases the minutes from its latest Federal Open Market Committee meeting on Wednesday. So we're going to get the June minutes tomorrow evening, our time. US data releases this week also include the release of June jobs report data on Friday. Actually, I'm glad I read that. We're going to have a live trade on Friday. Live trade. I'll just get the link and pop that in the chat. My apologies. I should have done that earlier, but it's in the chat now. All right. According to the Dow Jones, estimates for job growth slowed down in June, with 250,000 non-farm payrolls added, down from 390,000 in May. Economists expect the unemployment rate to hold at 3.6%. Shares in the Asia-Pacific region mostly traded higher overnight as investors look ahead to the latest rate decision for the RBA. Okay, and central bank action is also central to market sentiment in Europe this week. The Bank of England is due to publish its latest biannual financial stability report on Tuesday. The ECB is set to publish accounts of its latest monetary policy discussion on Thursday. Data releases include final June PMI indexes for the Euro area and French industrial production figures for May. Retailer Marks and Spencer hold an annual general meeting today. All right. Hey Anna, morning to you. I wanted to take a look at our 2-year, and I'm not sure this actually gives us much insight. To be honest, I'm finding this quite tricky to interpret. But I just wanted to carry on from our discussion yesterday, and I'll show you where the confusion or the complexity comes in a moment. But of course, this is our current period. The candlestick chart is our US 2-year yield. The black line is the Fed funds rate. You can see that they are very well correlated. What we suggested is that there may be an overshoot, and this is obviously very much conjecture at this stage. I don't know if there's an overshoot, but the question to ask is the US 2-year yield going to pull in as the Fed funds rate pushes up. We're going to get 75 basis points for this month. We'll probably get 50 in September. And that's interesting. September was priced in at 75. It's pulled back slightly to 50. And that's going to be data dependent. It pulled in last week after the quarterly GDP. The final number came in at a contraction of 1.6%. The PCE, which is the Fed's preferred inflation reading, shows also perhaps sign of stabilizing. So the question, of course, given that we're getting 75 plus 50, will we start seeing the US 2 years starting to pull in? And the last time we had a overshoot that's similar to 2022, goes all the way back to 1994. Anna was kind enough just to find the reference here. The financial reference is that there was a bond market crisis here. There was a huge sell-off in the global bond market going back to 1994. And there's an overshoot here. What I mean by an overshoot, you can see that after a string of blue candles, the US 2-year has a myriad of red candles. So it's initially overshot, and then it had a pull back, and then come and meet the Fed funds rate. So that's what we are trying to come to terms with. Is there an overshoot? At first glance, I think that a case can be made for an overshoot here. What I've done is I've added 2 RSIs. So let's just be very clear. The RSIs are very different. Well, the settings are the same, but the first one is the RSI of the US 2-year yield. Okay, so let's just understand what we're looking at. So if I double click on the middle chart here, this RSI, okay, it is a 10-year, okay, a 10-year, beg your pardon, a 10 period, not a 10-year, a 10 period, which in this case it's a monthly 10-year, and I'm using the close here. I'm not using the median. I'm using the close. I'll tell you why in a moment. It's not a big deal. It's just I wanted to make the settings exactly the same. But this is for the US government 2-year. The RSI at the bottom, okay, is also based on the close of the Fed funds rate. I don't have the option to do a median reading for the Fed funds rate if I do it as an overlay. So I just wanted to keep the readings consistent, so they're both based off closes. I don't think it's a big deal. And then we've got the blue signal line. Both of them are 9-period EMAs. So what's interesting with this type of relation, I guess this type of interaction, is that when the US 2-year yields RSI crosses below a signal, in other words, it's starting to lose momentum, okay, there is a lag. So the crossover is this, a big one, the green dashed vertical. Then there's a lag, and then the Fed funds rate RSI crosses over, and then we go into some sort of moderation cycle. Not generally a rate cutting cycle, although in 1994 wasn't much of a cutting cycle, but generally it follows these signals precede cut cycles. So the green vertical, which is the momentum of the 2-year coming down, I've labeled as signal 1, and then the Fed fund rates momentum cross, I've labeled as signal 2. So we get a pattern here, 1, 2, then some sort of normalization or moderation. 1, 2, back in 2000, then we get a rate cut. Okay, then we go through to the global financial crisis period, 1, 2. Okay, then there's that moderation. Go back to, this is now sort of the COVID period, 1, 2, moderation. And now that brings us to 2022, and we've got 1, 2, question mark, are we going into moderation? So again, at first glance, I would suggest that there is an overshoot here based on the 1, 2 signals. However, we've got to add inflation onto this, because we are in a period where inflation's at 40-year highs. So looking at the 1994 period, the 2000 period, the 2008 period, etc., you know, does seem to have some sort of pattern attached to it. But there's a time period bias here. So obviously a time period bias, because the underlying macroeconomic fundamentals are different. So if we throw in, let's just put in a core CPI. Why a core CPI? Because that's all that the fund can really, that's all that the Fed can really deal with. Can't deal with the producer side inflation, which is due to supply shocks. Can't deal with that, but it can deal with the core. That's effectively what the Fed's interested in. So let's overlay this with the core CPI, and this is where the complexity comes in. Okay, so let's do that. Okay, and we're just going to add it to the top chart. We'll give it a new scale. You know, it's got this. Let's just make this. Let's make this a very thick red line. Okay, so we can just clearly see it. All right, so there's very thick red. Oh, there's a lot of red there. Let's change this to a very thick. Make it a green, yeah, okay. And let's get these green boxes out. Okay, so here's the complexity, in that if we go back to 1994, well, inflation, it looks okay. You know, go back to 2000, core inflation looks okay. Go to 2008, core inflation looks okay. Go through to pre-COVID, core inflation looks okay. All these periods are marked with disinflation rather than with the inflation, right? You can see how it's been coming down. But not so much 2020 to 2022. We've got the complex situation where our core CPI is at 40-year highs. And that means that the time periods we're looking at are not the same, which makes this type of analysis very, very difficult, because we can only make inferences and hope that our sort of inferences are correct. What would have helped is if we could have gone back through to the stagflationary times over here, but unfortunately I don't have that data. So what we're going to have to do here is see if the pattern plays out as previous. Okay, in other words, that 1-2 rate cutting cycle. Let's see if we get that. And the idea, of course, is, well, it's all really a factor of whether we can get this CPI to come down. I think the core CPI, if it doesn't come down, inflation's going to have, the Fed's going to have no choice but to carry on raising, and then perhaps we haven't got the overshoot. So there's the complexity. There's another issue here, just to sort of make things a little interesting. I'm going to take the core CPI. So that's the first complexity. The second complexity is recession. Okay, so this again is a very tricky analysis, in my opinion. And what we want to do is we want to see yield curve inversions. Okay, so we're looking at the US 2-year. So we're going to throw in underneath a 210 yield curve and see where the inversions took place. And then we're going to try and figure out if we can have some sort of technical reason for the inversion. So what we're going to do is we're going to just go through and we're going to go plus here, and we're going to add in the 210s, in this case 10 minus 2s, okay, and we're going to add these to the bottom. Just going to have to do this again, bear with me one moment. Alrighty, so here's our yield curve. Now we've got a lot of charts here. I understand it's getting messy. I'm going to try to tidy it up in a moment. Let's just pin our 0. All right, so here's our 0. I think we can actually get rid of these RSIs for now. So let's just try and take these out. I can do it actually this way. All right, let's take the RSIs out. So this is tricky now. Remember, 1994 is our overshoot period. So let's just take a look at the overshoot period. But the overshoot period doesn't actually invert. Isn't that interesting? Okay, there's no inversion here. Again, suggesting that time periods are not similar. Whereas we're very close to a full inversion at the moment. I'm not talking about 1 or 2 basis points. I mean, we need an inversion. Needs to be an inversion, right? It needs to be significant. Okay, 1 or 2, that's just normal volatility off a very flat yield curve, but it's not an inversion. An inversion goes under 0 for a significant period. So inversion, 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 and we've got the 10s, 2s here. So we're missing one series here, which is obviously the 10s. So it's going to, again, apologize if the charts are getting messy, but I think we can make some interesting discoveries here. So let's just add the US 10-year onto this top chart. Before I do that, once you've added that, then we've got three series there that we're looking at. We're looking at the 10s, 2s, plus the Fed's funds rate. Okay, so we're looking at 3 things in the top chart. So let's just add that through. Let's add that in. All right, now obviously it's very difficult to see with both of these being candlesticks. So let's just change this up as well. We'll just align, and let's just make this a thick purple. Okay. All right, let's just see if we can figure out some stuff here. So there's an inversion. There's an inversion that comes over here. There's an inversion that comes over here. So what I'm looking to do is, okay, I want to keep an eye on this black line over here. I think we can actually take this purple out. All right. I think it's just making it messy. All right. So what happened with why didn't we invert in 1994? Is because the Fed actually doesn't push all the way up to the peak of the US 2-year. Can you just look at the black line here? It stops quite a bit down from the 2-year, and then the 2-year actually catches up to the Fed funds rate, not the other way around. And that's important. Listen to this very, very carefully. The 2-year, a big one, not the 2-year, the Fed funds rate stops. The Fed fund rate stops. Okay, let's go to the inversion over here. Let's go to the inversion over here. The Fed funds rate doesn't stop. It carries on moving up to catch up with the US 2-year, and we get an inversion. Okay, take a look at this inversion here. This is interesting. The cycle's not quite as lagging here, but the Fed fund rate still moves up, and that leads to an inversion. Okay, now this is the key because we're in 2022. Okay, we said something very, very it was subtle, but it was absolutely important. Okay, I'm going to just write it out here a little bit earlier. This is what we've got priced in at the moment. Okay. All right, so we've got the 75 basis points, 50 basis points still coming. All right. The black line here, the Fed funds rate, it hasn't stopped moving up. It hasn't stopped moving up. Okay, it's still going to move up. Every time we've had the black line moving up, as we approach the 0 line, we invert. As the black line moves up and we're near the 0 line, it inverts. Okay, what happened in 1994? There was overshoot, but the strange thing about why I think that the time period is different here is because the Fed funds rate stops moving up. Okay, and we avoid an inversion. I think we're going to invert. I think in 2022 we have to invert because of the fact that we haven't finished this rate cutting cycle here. Okay, so there is a difference between 1994 and where we are here. Now, the thing about an inversion, the tricky thing about an inversion is it doesn't necessarily mean we go into recession, but we can't have a recession without an inversion. Basically, what an inversion is telling us, okay, what an inversion is telling us is that I'm just bringing up my Microsoft Paint. We've got a yield curve like this. So there's 3 types of yield curves. There's 3 types of slope. We've got, this is a positive sloping. Okay, this is a flat, and this is a negative sloping. This negative sloping is what we refer to as an inversion. Okay, that's what we're talking about. So as soon as we drop below 0, it's telling us that our 2-year is higher in yield than our 10-year. Now think about that in terms of the market psychology. Okay, downward sloping yield curves, it's all about expectations. So if you are expecting lower interest rates in the future, well, that must be declining future inflation, which is what the Fed is after. But it's also implying recession or slowing of economic activity. Think about it very carefully. Why would you have lower interest rates in the future? It's to stimulate a slowdown in the economy. So an inversion is the market suggesting that it is expecting an economic recession or slowdown ahead. It doesn't always pan out that way, but the Fed over here, okay, is manufacturing an inversion, okay, and that is very, very interesting. Now the key is how vicious is the this sort of manufactured type of recession going to be? Well, for that, we're going to see the job numbers on Friday. Job numbers on Friday. So the unemployment rate is probably the least important. Okay, that's going to lag. But the job numbers, the NFP payrolls, that's coincident. That's coincident. We already read this morning that it's starting to decelerate. So the coincident is starting to decelerate. We're also going to get something called the JOLTS numbers later in this week. That's the job openings. Chris asked us about that last week. We want to actually start keeping an eye on the JOLTS numbers to see if they start coming in. And of course, we want to take a look at our initial jobless claims. So we spent a lot of time on this previously. So we're going to bring up our initial claims. I just want to get rid of the Fed funds rate here, which is this guy. All right, and we'll put this on to logarithmic. Incidentally, before I change this, before I change this up, let's keep the inversions with the initial claims, and let's throw in some vertical lines here. You'll see something very interesting. Okay, so here's where the inversion takes place. Okay, here is where the next inversion takes place. Here is where the next inversion takes place. And you can see that the initial claims actually kick up at these inversions. This is an abnormal. This is abnormal. Okay, so I think we can disregard COVID, but the idea is here the initial employment start kicking up, right? So we want to just keep an eye on the. So we want to keep an eye on this inversion. I think that there's little doubt. There's little doubt that there's going to be, in my mind, with 120 basis points on the table, it seems that we have. Okay, no worries, Anna. There's no doubt we're going to get the inversion. Okay, so given that, let's just take a look at the weekly data here. And again, just an email I got from Rob was, is it useful to use a stochastic on the initial claims? And he make some very good points. The fact that this is just one, there's no open, high, low, close. There's a close effectively. It makes the stochastic wrong indicator to use, because you're not getting a reference to the range. So I think you're quite right there, Rob. So what we'll do is we'll just add in a moving average here, and we'll just keep an eye on this with the 3-month simple moving average. And the moving average starting to creep up, right? So we're looking at weekly data. We'll take it as a 12. We'll take it as a 12-week. Okay. 12-week just to give us 3 months, right? We just want to keep an eye on this because clearly it's not optimal to have your initial claims above your 3-week average. The other point I think that we're going to make is it's worth keeping an eye on the continuing claims. Okay, because what's going to happen here, if we do go into recession, the initial claims will have to cross over into the continuing jobless claims. So we want to just keep an eye. There was a very obvious convergence towards the 3-month moving average. We want to see if that crosses over. That again would be not a really good sign to have. So we want to just keep an eye on that. All right, so now here's a video I'll just on bonds. She's saying she's having a tough time getting her head around bonds. Yeah, it's not my most comfortable financial instrument either. I'll just send this to everyone. Okay, so I haven't watched this video, but it's from Anna, so you can have a look at that. I'm not sure, you know, what's in it, so just bear that in mind. All right, so with that all said and done, let's have a quick look at the DAX, which we've sort of left. I've got to Euro, by the way, as well. I've got a position in Euro. Right, let's just take a look at DAX. Okay, so you can see with this sort of recession danger looming, take a look at where we are in terms of our technicals, lower peak, lower trough. For me, the big deal here is the momentum. That's really the big deal, and we came to this lower quintile. I'm very nervous about that. So we've got two things to watch with DAX. Does the support level give way, or does it hold? And if it gives way, do we maintain a lower quintile position? Because that would be really, I think, painful if it unfolds. Then we've got this zone 3 on the daily chart, and what we were looking at yesterday was a potential 1, 2, 2, 3. Never really broke the pattern. I think what we can do is still monitor this in terms of a 1, 2, 2, 3. I think it looks a bit odd to keep it as a flag. Let's just make it like this. And so we've got 1, 2, 2, 3, and then possibly take a look now at our triggers. Take a look at our triggers, getting a potential crossover, not quite there yet. Okay, crossover, not quite there yet, right? I think we're going to wait for this hour to complete because we're at this central pivot support. But if we do crossover, then it's all about making its way through to the lower quintile. Just in terms of the euro US dollar, all right. So I've actually got a short on here. I put it on over there. Okay, and short's still on, and I can see it's actually starting to move. So I just want to see if our momentum builds here. Alrighty, I think that's where we can leave it for this morning. Don't take anything I say as advice, please. I make losses on trades as well, so just be cognizant. So stop. I didn't trail stop at this stage, so I'm just waiting to see if this pans out. Any questions? All right, we'll stop here. Tomorrow we'll do the crypto minute as well. Okay, and I think that we're going to have to discuss the cryptos. I think there's a new dynamic that may be developing, and it's all around the dollar. Okay, so we'll discuss that tomorrow. All right, guys, thank you very much and have a good day. We'll chat tomorrow. Cheers.